Hello students, I welcome you all for our lecture number 5. In this chapter, we will discuss investment decision rule. This is the outline. Basically, when we are evaluating our decision of investment, we have two different methods, discounting method and two non-discounting method. In the discounting method, we have NPV, IRR, modified IRR, and then discounted payback. In non-discounted methods, we have only payback. And then in the last, we will discuss equivalent annuity method and then profitability index. Okay. To understand the valuation, first of all, we have to make a differentiation between distinction between independent project and mutually exclusive project. Independent projects are basically the one where if we accept project A, we can also accept project B, no problem, right? If we have funds, we can do that. And the projects are basically unrelated. They are diversified projects. So if you accept A, doesn't mean we reject B. If you accept B, doesn't mean we are rejecting A because we are accepting A. It happens when we are going to mutually exclusive projects where if we accept A, we have to reject B. Okay, and because they are related projects, so these are called mutually exclusive. If you are accepting B, we have to reject A. So they actually do the same function. For instance, if you are buying a car, so we can have two different options. We have Kia and we have Toyota. If you are accepting Kia, we have to reject Toyota. So these are actually mutually exclusive projects. Now we can also classify the project based on their cash flows. First of all, we have conventional cash flows and then we have unconventional cash flow. Conventional cash flows are the one where the cash flows initially they have negative and after that at the end it should have positive, right? So these cash flows are called conventional cash flows. No matter what happens in between this time period, it could be negative, positive, negative, positive, no problem, right? Until unless you have negative in the start and positive at the end, you can call it as a conventional cash flows. Unconventional cash flows have number one, negative and positive here. If it has a positive in the start, it is straight away unconventional, right? Then if anything happens, negative, negative, negative or positive, positive pattern, we are not concerned until unless if it has a positive or inflow in the start, it is automatically an unconventional cash flow. We will see a chart, then you can easily understand. Okay, if you see this chart, in the start, if you have an outflow, right, and at the end you have inflow, straight away it is conventional cash flow. In the start, it has outflow, so it can be conventional or unconventional, but we have to look at the last one. It is negative, so it cannot be conventional. It should be positive, right? So it is negative, it can be conventional or unconventional because it is negative. In the start and at the end it is positive, so it is conventional, right? It is positive, unconventional, no need to look the coming years cash flow. So it is negative, it can be conventional or non-conventional, but if we go at the last year, it is negative, so it is straight away unconventional. Now we have the first method of our project evaluation, that is NPV, and this is part of discounting method. Okay, so the first method is NPV. So this is also called shareholders wealth maximization method. Sorry, I don't know what is wrong with the ink today, so it's creating some messy things. Okay, so it is also called shareholder wealth maximization method. And how do we calculate NPV? NPV is equal to inflows minus outflow. Okay, When I say an inflow, there because discounting method, so we will call it as present value of inflows. And then outflow, it should also be present value of outflow. Okay, and normally the outflows are the cost for a project. Okay, so NPV method of the NPV is equal to our inflow and outflow, and because it is discounting, we call it as present value of future inflows minus present value of future outflow, or present value of future of just outflow, or present value of cost. Okay, so if NPV is greater than 0, it means you are making profit, so your wealth of the shareholders has increased, except the project. If NPV is negative, less than 0, it means your inflows, your benefits are less than your cost, then you have to reject it, so it is not contributing in shareholders wealth. Now let's look at the formula. NPV is equal to C naught. It is negative, not positive actually. I'm not sure why is it is negative, and these are basically your inflows, but inflows are present value of cash inflows. Okay, if you can see, so the formula for NPV is outflow minus present value of cash inflow, or you can also say inflow. You can also place these inflow first and then outflow later to get this NPV. Okay, so let me do it for you. Okay, so there is a mistake in this formula. What is the mistake? So it should be negative. So cash C means the cash flow, or you can CT are basically cash flows. It could be inflows or it could be outflows. Okay, and R is the cost of capital. Opportunity cost of capital, it means if a manager has invested the money in some other project, it could at least get that return, right? And N is the project's estimated life, and here. Okay, so the cost of capital mean it is the minimum return that the investment should actually earn. Okay, so if the company has taken some loan and cost of capital is 15%, it means the project should at least earn 15% because it is the cost of the company. Okay, so it should at least earn this return. Okay, and normally this is a separate chapter. This is chapter number 10, I guess, where we will discuss cost of capital. So we will deal this in more detail. Okay, and we call it as weighted average cost of capital. We will discuss this in more detail in the separate chapter. For this slide, you just need to remember the formula. Now let's take an example of NPV. A fertilizer company can create a new environmentally friendly fertilizer at a large saving over the company's existing fertilizer. Okay, so it's a new project. The company wants to introduce a new project. The fertilizer will require a new factory that can be built at a cost of 81.6 million. So this is the cost, initial cost of the project. Estimated return on the new fertilizer will be 28 million. So this is return, right? So this return are basically the cash flows after the first and last 4 years. So it means your earnings would be 81, 28, 28, 28, 28 for how many years? For 4 years. Okay, so you are going to earn 28 million for 4 years. So the life of the project is N is equal to 4, cash flow is equal to 28 for 4 years. And how do we get this cash flow? This is a separate chapter and we will study in chapter number 9. Okay, we'll discuss in detail. Now how do we get the NPV? So this is your outflow and these are your inflows. So you have to find the present value of these inflows. So you have to find the present value of these inflows and you have this outflow. Okay, then you can find the NPV, and the cost of capital is 10%. Okay, so it means the company has taken the loan at the rate of 10%. so that is 10% is here. So what is the NPV? That is 7.16. okay, so it is positive. NPV, if you see, your inflows are higher than your outflow and NPV is positive, so it means we should accept the project. So if you're using the financial calculators, these are just the methods you can follow to find the answer. The answer will remain same. And also because cash flows were 28 and it was for 4 years, so you can also apply the annuity formula. So using the annuity formula, you can get the present value of cash inflows, and you get it using this formula, and then you get the NPV, that is equal to 7.16. So the NPV is positive, which indicates that the company will increase the value of the firm by 7.16. so it should undertake this project. So it means the shareholders' wealth will increase by 7.16 million. So that is the NPV. Now the question is, if we have mutually exclusive project, mean if we accept A, we have to reject B. If the projects are mutually exclusive, then which one should be accepted? All positive should be accepted? No, we will only choose the one with the highest NPV. For instance, A has an NPV of 100 and B has an NPV of 70. So which one? Because both can be accepted because NPV is positive, but out of these two, which one should be accepted? This one. Okay, the project must be ranked and the best one chosen. The best one is A. Here is another example of NPV, that we have two projects L and S for a given are given below. Cost of both the project is 10%. It means we have the financing at the rate of 10%, but we are given two projects, project L and S. So which one should we accept? And both have the same investment. Initial cash outflow is same. So which one should we accept? Just simple find the present value NPV. NPV of the L is 18.96 and for the S is 19.99. So which one should we accept? We should accept S because it has the highest NPV than project L. Although both are favorable, but S is giving us more shareholders wealth. But if they are independent projects, we can select both, right? But if it is mutually exclusive, we will select the best one. Okay, so shareholders wealth will be maximized more with the project S. And remember the last statement, if L and R are independent, we can accept both the project because their NPVs are positive or greater than 0. And these are the financial calculators guide, so you can use that with your financial calculator and you will get the answer. Now there are some benefits and merits and demerits of using NPV. Merits are that it considers all the cash flows. All the cash flows mean inflows as well as outflows, okay, and recognizes time value of money, of course, because this is a discounting method, and it gives you a direct measure of how the project will increase the value of the company. If it is 100, so it means value of the company will increase by $100. Okay, disadvantages mean it requires a lot of forecasting. If you see, you are here, how do you know cash flow? 1, how did you get it? C2, how did you get it? So it requires actually forecasting, right? So when you do the present value of cash flows, so how do you get these cash flows? This is a separate chapter we will discuss in detail. So but they are forecasted, so it requires a lot of time, and it can be time consuming and relies on accurate estimate of the discount rate. 10% discount rate, we use that, but it should be accurate, right? And then it is not suitable when the comparing mutually exclusive projects with the unequal lives. For the projects with equal lives, we can use NPV, but the project with the unequal lives, NPV is not usable. We will use another method. Just remember this point, we will discuss in the last few slides. I will explain it in more detail. Okay, so overall NPV is considered to be the most theoretically correct criterion for evaluating capital. Out of all the techniques, NPV is normally considered the most accurate one, or mostly used one, a widely used one. Okay, now let's discuss the second method. The second method is basically internal rate of return, IRR. First of all, you need to understand that IRR is the method where you are at break even, right? If you see, NPV is equal to present value of cash inflow minus present value of cash outflow, right? When you are at break even, it means you are not making any profit. When you are not making any profit, then present value of inflow should be equal to initial cost or present value of cash outflow. Okay, so it means internal rate of return is that percentage rate at which your NPV is equal to 0, number 1, or your present value of cash inflow is equal to present value of cash outflow, or it is the rate at which you are at break even. Okay, so that is the rate. So how do we get it? So first of all, we need to understand this one. Okay, so for that I am giving you an example. Let me draw a formula for you. If you see, the present value of cash inflow is equal to C divided by R, right? Then 1 minus 1 over 1 plus R power n. Okay, so this is the present value formula. And if you see, this is called cost of capital. Okay, the formula is NPV is equal to present value of cash inflow. No, let me do it again for you. NPV is equal to present value of cash inflow minus present value of cash outflow. How do we find inflow? Inflow is equal to C divided by R, 1 minus 1 over 1 plus R power n minus present value of cash outflow or initial cash outflow. Okay, so if you see in this formula, if we increase this R means R is equal to cost of capital, right? Okay, if you see, NPV is here. If you see, if we increase the cost of capital, what will happen? This answer will go down, the answer will be less, right? And our NPV will also decrease. So if you see, if the cost of capital increases, NPV decreases. You can just simply see this from this formula, right? If you increase cost of capital, NPV decreases. So it means there is an inverse relationship between cost of capital, that is R, right, and NPV. So it means if it is 0, if you put this cost of capital equal to 0, so it means you will have the maximum inflow and your NPV would be maximum, right, here. But if you increase this cost of capital, it means denominator is increasing, so then you have to subtract the cost also. Your NPV will decrease, so your NPV will start decreasing. Let's say when we are at this rate R, at this R, your NPV is 0, right? So this R is basically called IRR. Okay, so let me draw it again, maybe the cleaner one. Okay, with some, okay, so this is, okay, this is, let's say this is NPV, and this is on the other side we have cost of capital, RC, cost of capital. Okay, so if you see the cost, with the increase in the cost of capital, what will happen? NPV will go down, go down, go down. So at this, if you see on the x-axis we have RC, right? So it means at this point your NPV is 0, right? And this R is equal to how much? We don't know, right? R is how much? We don't know. So that R is called, we call it as theoretical rate, we call it as, we call it as IRR. Okay, after that your NPV will become negative. Now you understand, basically there is an inverse relationship between NPV and IRR. If R, or the cost of capital, if in the market your financing cost is very high, that high your NPV is 0, that IRR, that rate is called IRR, right? So first of all, there is an inverse relationship between NPV and cost of capital. If the cost of capital increases up to the point where your NPV is 0, that cost of capital is called IRR. So IRR is the cost of capital. Remember, this is not different, okay? The cost of capital at which your NPV is 0, right? So it means, if you see, let's assume your IRR is 20%, okay? So at 20% you are not earning anything because NPV is equal to 0, okay? You're not earning anything. But if, so it means you have an idea that, okay, at 20% you will earn nothing. So in the market, if market is offering you 25% rate, would you accept it? No, because you will say that, okay, if my financing is 25%, I will be making loss. Why should I choose those projects, right? But in case if in the market you can get the financing or cost of capital at 10%, for instance 10% is here, right? So you see at this you have the NPV is positive, right? Okay, so it means this IRR is the theoretical rate at which your NPV should be 0. Once you get this rate, then you know the idea that, okay, if in the market, if financing is more than 20%, I'm not going to take that project. If the financing practically is at 15%, okay, I will take that because I will earn some positive NPV. Okay, so remember, IRR is a theoretical rate at which your cost of capital or at which your NPV is 0. So you get the an idea or guess. So it means in the market, then you compare your financing cost with the IRR. Now let's go to the slide. Now you see, if the IRR is greater than cost of capital, it means the cost of capital is 15% and IRR is 20%. It is greater than, right? Cost of capital means in actual you can get in the market at 15%, but in NPV at 20% your NPV is 0. This is break-even point. So IRR is 20% and actual rate is 15%. So if your IRR is greater than your cost of capital, you will accept it. So it means even if your cost of capital is 16%, still you can accept. If it is 19%, still you have a positive NPV, right? So if the IRR is less than cost of capital, you have to reject the project. I hope you got it. Now let's take an example that we have two projects, project L and project S, right? Both have the same outflow. Present value of cash outflow is 100, present value of cash outflow is 100, or initial investment is same, and the cost of capital in the market you can get it at 10%. For instance, if you want to go to the bank, and bank will offer you the rate at 10%, but you don't know whether at 10% are you going to make any profit or loss. You don't know, right? So first of all, let's see, you are not calculating first of all you want to see what is the IRR of these two projects, right? Which project should I use? Okay, first of all we saw that. Let's see what is the IRR. Let's say IRR of the project A is 18.13. let's say IRR is the rate at which your NPV is 0. So let's say what is the IRR for L and what is the IRR for S. Okay, how do we get it? The formula of NPV is equal to present value of cash outflow. Because this is negative, then you can write it. We can write it positive here because this is already in negative. Okay, sorry, in the maybe in the first statement slide of NPV I made a mistake, so it is negative. Okay, so this is outflow is negative, then you have to add inflows are 10, 60 and 80, but we don't know what is the rate at which your NPV is 0. So how do we get it? In this formula they have given you the direct answer 18.13 and 23.56, and your NPV is equal to 0 in both cases. Okay, but what is the rate? How did we get this 18.13, right? But for sure we know that at this rate, if we use this rate, and that is 18.13, our NPV of L would be 0, and if we use 23.56, our NPV will be 0. So which one project, if both are mutually exclusive, if both the projects are mutually exclusive on the basis of IRR, which project would you choose? Of course we can choose both the projects if both are independent, because if you see the cost of capital is 10%, it is less than IRR, right? IRR is higher than the cost of capital, higher than 10%, it is also higher than 10%. So we can straight away go for project S because it is giving us higher IRR. Why is that? Why is it more preferable? It is because even if cost of capital is 10%, let's say if the cost of capital is 22%, okay, can you choose this project? No, you cannot choose, you will make loss, but still you can use this project. So that's why higher IRR gives you the flexibility for financing. Higher IRR means higher flexibility. Which flexibility? Financing. It means if in the market interest rates goes high, still you can go for project S. Even you cannot choose project L, right? If it is 22% or even 20%, you cannot use that. Okay, so now the next question is, how did we get this IRR? How can we find it? For instance, if we can use this formula, you cannot do that, right? So how can you do that? So the method is called hit and trial method. This is the same method I last time told you to calculate YTM, right? So I have solved this question for you. Let's use this one. Okay, hit and trial method, this is also called interpolation. And first of all, you need to see that what is your outflow. Cash outflow was how much? -100. So cash outflow, this was present value of cash, this is the investment. Okay, so it means you want you need to calculate the IRR, because at IRR your NPV is 0. So it means if first thing we know that our present value of cash outflow is -100, if our present value of cash inflow is also 100, then our NPV would be 0. It means we should find a rate at which our present value of cash inflow is 100, right? So we need to find that rate. Okay, so that is the formula that you need to use. R low, L mean rate, lower rate, okay, plus present value of cash, present value at the lower rate, minus PV original is how much? Outflow is how much? 100,000, right? So that is actually the given information, or initial outflow, divided by present value of at lower rate minus present value at higher rate, then multiplied by return that you are using higher rate, then lower rate. Okay, remember, we know that there is an inverse relationship between the cost of capital and the present value. So if we increase the cost of capital, your present value will decrease. If you are decreasing your present value, if you are decreasing your rate, your present value will go up, and if you decrease it, it will increase, right? Because it is an inverse relationship. So it means if we use at 10%, our answer is 118.78. So your present value of cash inflow is 118.78. it is greater than 100. So to calculate IRR, you need to get one PV as the highest and one PV as the lowest of what? Lowest of your initial outflow. Okay, so the first case is done. We have got the highest present value, and in the next part we need to get the lowest one. Okay, so if you are using the higher discount rate, your answer would be lower, right? So it means if you are using this 20%, your answer is 96.30. okay, now we got it that we have 100 here. We have got 118.78 at the rate of 10%. It means when we use 10%, this is the answer, and if when we use 20%, our answer was 96.30 at the rate of 20%. Now you can ask me a question, sir, what rate should we use? So you can use any two rates. You can use 5% and then 25%, then you can easily get the answer. Okay, no problem. Now, so this 10% I choose it arbitrarily, it was not intentional. So you can also use 15%, right? No problem. So our L was 10% plus present value of lower rate. L mean the rate that you use. Okay, that is 118.78 minus present value of outflow. Okay, divided by present value of the lower rate minus present value of the rate that you used higher. So multiplied by higher rate, that is the rate higher minus rate lower. Okay, so once you solve this, you get 18.3%, and if you see the solution, you will get 18.3% for the first project, and for the second you can also find it the same way. It will be 23.56. okay, so it means we should use the project, we should select the project S because it is giving us the higher IRR. I hope you got it. Okay, now the rule is, let me explain the rule for the last time, that when you are finding IRR, first of all you have to see what is the outflow. Outflow was given 100, right? So this is the target area. So one answer you should get higher than 100, and one answer you should get lower than 100, like higher than 100 and lower than 100. How would you get the answer lower than 100 if you use lower rate? And how would you get the answer lower than 100 if you use higher rate? Why? Because discount rate and the present value has an inverse relationship. Okay, so our present value of cash outflow was 100. So the lower rate we used was 10%, and the higher rate that we used was 20%. And at lower rate, what was the present value of cash inflow? It was 118 point something, and for this one it was 90. I don't know what was the answer. 96.31. okay, so you can see that. Okay, once you will get this, then we can apply the formula. Okay, now the starting point 10% or 20%, you can use 15% or 25%. So you can, it's up to you how do you do that. And okay, so last thing, IRR is basically the rate at which your NPV is equal to 0. So it means when we want to find the NPV, we have one thing that is for sure, that is negative 100, but this part should be equal to 100. So that's why our NPV would be 0, right? So how can we get this part equal to 100? So we have to use the IRR. Okay, so how to find the IRR? This is the method. Okay, Now this slide actually tells you that if the projects are independent projects and the projects are cash flows are conventional, right, then if NPV is saying that we should accept the project, then IRR should also say the same thing, right? How? Let's go to the previous slides. Okay, let's go to the NPV slide. If you see in the NPV, which project was more favorable, that was S, because based on NPV, right? So we selected project S, and based on IRR, which project is the best? That is still the S1. Why? Because the projects were independent, okay, and the cash flows were conventional, because in the start we had negative 100, and then we had positive, right? So if the projects are independent projects and the cash flows are conventional, then there will be no disagreement. Both will tell the same thing. Both will favor S. Okay. Now when the projects are mutually exclusive and when the projects have unconventional cash flow, then if NPV is saying to accept the project S, right, IRR would say to select the project L. So then there will be disagreement, right? So disagreement normally happens for the mutually exclusive projects and unconventional cash flow you need to see. Okay, and if you see this one, if NPV is greater than 0, it means IRR should also be greater than cost of capital, then accept the project, and the same thing will go for the less than and equal to. Okay, let's see these two projects. Let's see if we can find the conflict between the two mutually exclusive projects. Okay, the situation is mutually exclusive projects. Okay, project A and project B. Okay, so if you see, if the discount rate is 0%, project A will give you 50 while project B will give you 65, highest possible, right? Because this is 150 and minus 100, so you will get 50, and it will be 165 minus 100, it will give you 65, because there is no discount rate, considering it is very free, right? But if you are paying some cost, discount rate is 5%, 10%, 13%. If you increase the discount rate, NPV should decrease, right? This is what we last time studied. If you increase the discount rate, your NPV should decrease, and at that point it was called IRR. Okay, we remember that. Okay, so based on NPV, if you see which project is giving you highest NPV, you will say, hey, it's project B, because it has the highest NPV than project B, because it has the highest NPV than A, and based on IRR you are accepting project A, right? So you see there is a conflict. Based on NPV you are accepting B, while based on IRR you are accepting project A. So if you see, after some time you see that, okay, if we keep increasing our rate at 15% until 15%, before 15% you are still favoring project B, because this NPV is higher than this one. Okay, but after at 15% you see your NPV of the project B decreases while the NPV of the project A increases, right? And here it is negative, but still it is positive. Mean after 13% the situation gets reversed. Now NPV is favoring this one and NPV is not favoring this one. Why? Because of this different IRR. So the purpose is, if we have mutually exclusive projects, then NPV and IRR are not giving you the same answer, so they will disagree. So when they will disagree, so it means there is a conflict, right? So if you see the conflict in ranking, B has a lower IRR but higher NPV before 13%. Before 13% you see B has the higher NPV but lower IRR, but after 13% A has the higher NPV, right? And also the IRR is already higher, right? So conflict is B has lower IRR but higher NPV before 13%. And what is the no conflict area? It means after 13%, maybe 15%, A has the higher NPV as well as it has higher IRR. So after 15%, then there is no conflict, but before 15% there is a conflict. Overall, what is the conclusion? Conclusion is when the projects are mutually exclusive, we are not really sure which project should we choose, right? So that is why NPV and IRR, they give the misleading results. When the projects are mutually exclusive, then we have conflicts. Okay, now I want you to understand this situation. When we have mutually exclusive projects, of course we learned that there are some disagreements on conflicts. If you see from 15% onward, from here onward, the NPV of A is higher than NPV of B, higher than B, higher than B, higher than B, and also IRR is higher than A, right? So it means starting from 15% there is no conflict. But if you go behind this 15%, you see that the project B is preferable based on NPV, while based on IRR project A is preferable, right? But after 15% project A is acceptable. Okay, so let me explain it to you. It means at this 15% is the rate. Before 15% NPV of B is greater than NPV of A, right? And also we are based on NPV, we are selecting this one, and IRR of the project is higher. In both cases IRR project A is higher than IRR of project B. So there is a conflict. Based on NPV we are selecting this one, based on IRR we are selecting this one. But after 15%, if you see, NPV of A is higher than NPV of B. Also IRR of A is higher than IRR of A is higher than IRR of B, right? So it means after 15% there is no conflict. Okay, so before there is a difference between before and after. Before 15% there is a conflict, and after 15% there is no conflict. So how do we get, the question is, how do we know what is the rate after that we should be careful? I mean, how do we know that is the 15%, right? Okay, let me explain it to you. Okay, so I hope you understood this one from here. After 15% NPV of A is higher than B, also IRR is higher than B, right? So let me explain this. So if you see, when your cost of capital was 0, NPV of A was 50 and NPV of B was 65. Simple, right? So when we increase the discount rate, the NPVs of both the projects decreased, and project A has an IRR of 20%, mean NPV of the project A will be 0, NPV would be 0, and project B has an IRR of 19%, right? So if you see, if you are here, if you use this discount rate, which project are you accepting? This project has the higher NPV than this project. From here, this project still has the higher NPV, but after this point, if you see at this point, NPV of both the project is equal to NPV of A is equal to NPV of B. So if we go down, so that rate is called crossover rate, right? So that crossover rate is the rate after that the situation reverses. If you see the situation after this crossover rate, NPV of A is higher than NPV of B, also IRR is higher than IRR of B, right? So this is called a crossover rate, right? So it means if you see this 15%, that is 10.6 and 10.1, that is nearly equal. If we just see maybe 15 point something percent, then the answer would be same. But after 15%, the situation favors the project A. So same here, for instance, if it is 15 point maybe 2%, the situation of crossover rate, the situation will favor project A, right? So that is called the crossover rate. So the crossover rate is called the rate at which NPV of both mutually exclusive project is equal, and if your cost of capital in real, okay, so now you got the, for instance, now you got the crossover rate, that's, let's assume that is 15.2%. you have got the IRRs. So all of these are theoretical, but actually when you go into the market and the market offers you the rate is let's say 22% for instance, so you will say I'm not going to select any of the project because cost of capital is higher than the IRR of both the projects, right? So let's say another situation, the market is offering you 10%, then you will say I'm not really sure which project to choose, but because based on NPV you will accept project B, but based on IRR you are going to select project A. So still you are not sure, okay? But normally suggestion is to go on the basis of NPV, okay? But then if the market is offering you the rate of 17%, I'm not sure why is okay. If the market is offering a rate of 17%, then which project should you go for? Definitely you will select the project A because it is higher than the crossover rate. If you see, if it is higher than the crossover rate, then you are going to go for the project A, right? So you can read these statements, they are actually the one that I explained. Now let's see another example. Previously there were two mutually exclusive projects, right? Now we are actually looking at the projects are they have unconventional cash flows, okay? So let me select okay. Here the projects, they have unconventional cash flows. So when cash flows are unconventional, then IRR and NPV they give misleading results. So unconventional means how? Negative is okay, but if it has a positive at the end, then it is conventional, but it is negative here, right? So the cash flow pattern is unconventional, okay, or non-conventional. So it means here IRR means IRR is the rate which brings your NPV equal to 0. It means what does it do? Present value of cash inflow should be equal to present value of cash outflow. Here we have two outflows, right? So two outflows mean there are two IRRs, right? So two IRRs are 25% and 400%. So in such situations where we have more than one negative outflow, then we have two IRRs. In that situation we cannot trust, we cannot rely on IRR, so we need some adjustment, okay? So NPV is saying that we should reject it, and IRR are 2, so which one should we choose? Don't know, right? Ideally this looks good if it is only single, but we are given two IRRs, so we cannot decide, okay? So the conflict is here. Conflict is saying NPV we should reject, but IRR, there are two IRRs, so we cannot decide. Then there is another problem. we have two projects. We have a project, for instance, in the start. This is also a non-conventional cash flow, but it has positive in the start and positive at the end, and negative in the is the interim, right? So we cannot find IRR in that situation. We cannot do that, right? It's not possible. If it is negative in the start, then we can think of different IRRs, but if it is negative, if it is positive in the start, cannot do that. But NPV, yes, we can do that. NPV is 33E9. Okay, so again here NPV is the only way out. IRR we cannot trust. So what is the solution then if IRR has some problem? Mean when we have non-conventional cash flows, it means if we have one or two negative cash outflow, we have two IRRs. So what is the solution? It means this IRR needs some modification. So that is why we study IRR. So this is a problem we just discussed. 1000 in the start, then in year 1 we have 3000, and then 2500. If you just keep using these discount rates and apply the formula, you cannot reach NPV is equal to 0. You can see that you cannot find any IRR here. So after reaching this point, it will start increasing. So it means you cannot, even if you keep increasing your discount rate, you will not reach an NPV is equal to 0. You see, after 1 to 5 to 200, right, you can see there is higher increase in the NPV. If we slightly increase 50%, there is higher increase in NPV. We cannot reach NPV is equal to 0, right? So we cannot find it. So then what are the advantages and disadvantages of IRR? Easy to understand. We can easily find a rate at which we should know that at this rate we are not earning anything, we should get our financing below this rate. So this is a positive rate and this is negative area, right? And based on the discounted cash flow technique, it also accounts for the time value of money, because we are considering this is a discounting cash flow method. Disadvantages: with mutually exclusive projects and the IRR can lead to incorrect investment decision. We just saw that. And with non-conventional cash flows, again we have multiple IRRs, right? Number one, if the projects are mutually exclusive, then we cannot choose IRR. Number two, it gives misleading result. And number two, when the cash flows are non-conventional, mean positive in the start and then we have different stories, then we cannot do that. Okay, we cannot use IRR. Then what is the solution? The solution is modified internal rate of return. Okay, now the solution for the IRR is that multiple IRR is that we can find modified IRR. So it comes the problem of multiple IRRs, okay, not IRR, multiple IRRs. And then we can compute the discount rate that sets the NPV of the modified cash flows to 0. And basically it helps us to finding the rate at which your NPV is 0, right? So the problem of multiple IRR will be solved. And what are the steps? Steps are, if you can just see this timeline here, it will be easy for you. So for instance, we have outflow here and inflow here and outflow here. What do we need to do? We take all the inflows to terminal. So mean we have to find the future value of all the cash inflows, right? So the what is the terminal value? Mean we need to find the future value. Oh my god, what is the problem with this one? Okay, we need to find the future value of the positive one and the present value of the negative ones. So if you see the present value, this one plus the present value of this one, you will get, this is power 2 because this is here. Okay, so the answer is 2164. So this is the present value of cash outflows. And what is the inflow? We need to find the terminal value or the future value. So that is 2875. So what are the steps? take all the positives to the end and take all the negatives to the start, and then use the formula that the present value formula is equal to terminal 1 plus MIRR power n. So n here is 2, so that's why we are using 2. So if we incorporate all the information, our MIRR would be 15.25%. so this is greater than 15%, that is the cost of capital, so we should accept the project. Okay, this will also follow the same rule of IRR, but this is how do we get it. Okay, so what is the situation? That take all the positives to, let me do that for you. If we have negative here, negative 1000, then positive 200, then negative 500, take all positive, mean find the future value using the discount rate at the rate of 15% in the previous example, and take all the negative to the present, right? So present value of this negative 500 and this negative, you get all the present value of the outflow and the future value. Once you get this, what is the formula? Future value is equal to PV 1 plus MIRR power n. We want to find this one, so what do we need to do? So future value divided by present value power 1 by n is equal to minus 1 is equal to MIRR. If you adjust it, you will get this answer. Okay, now let's go to the payback method. Payback method is called is basically used to compare two projects. If we have one project, we cannot really compare it, but if we have multiple projects, we can compare them. The shorter the period is, the better it is. If two projects, project A gives you your investment in 5 years back, and in project B gives you after 7 years, of course we are going to select this 5 year, because we will earn our initial investment early. So based on the notion that the opportunity that pays back the initial investment is the best idea, calculate the amount of the time it takes to pay back the initial investment, called the payback period. Okay, so here the payback method means if our investment is recovered in a given time, what is that time period? Okay, so we need to find the time period. How do we get it? Payback period is equal to year before the cost recovery, right? For instance, if the cost is happening in year 4, you can cover it, then you use 3 plus remaining cost to recover divided by remaining cost to recover mean the difference between 4th and 3rd divided by cash flow of the 4th year. Okay, then let's see a question, then you will understand. Okay, cash flow for project L and S. There are two projects below. Which project would be accepted based on payback rule? If all the projects are required to have a payback period of 2 years or less. Okay, if it is given that 2 years is the condition, then we should accept the project which has less than 2 years. Okay, so for instance, this one has 100 is the initial investment and 100 is the initial investment. Let's see which project is giving us the lower payback. So the first project has the cumulative 100, we need to recover 100, and then first year we are going to get 10, so 100 is the cumulative and you are getting this one. How much is left? 90. In the next one you are going to get 60, right? So 60, when you recover 90 plus 60, how much is left? 30, right? 30. And now in next, it means still we can go for the next period. 30 is not yet recovered. If you see next period, you are going to get 80, but you need how much? 30, right? So it means year before the full recovery is year 3, right? So we will stop at year 2 plus how much is left? 30. So how much is left is 30 divided by the cash flow of the year, that is 80, 2.375. Okay, so if you see the condition was 2 years, the payback period for this project exceeds 2 years, so we are going to reject it. How about the S? For the S, 100 is the cumulative. First year you are going to get 70. How much is left? 30. Next year you are getting 50, right? But you require how much? 30. So you are getting more than you require. So that is 30 remaining, and that is 1 because 1 year before you actually get the money total out. So 1 plus 30 is the required divided by 50, so 1.60 years. So we are going to accept the project S. Now what are the advantages and disadvantages of the payback method? Payback method actually gives you an indication of the project's risk and liquidity. This is just an easiest way to find that whether are we going to get our investment or not. So it just tells you that in a very simple way what is the risk and liquidity, right? Not in a very comprehensive way, but it just gives an idea of project risk in terms of time period, right? And what are the disadvantages? It ignores the time value of money. We did not see any discounting, and there is no such guidance as the correct payback cutoff, like 2 years, 3 years, we don't know. And it ignores the cash flows after the cutoff completely. For instance, if the project is for 5 years, you are going to receive cash flows for 5 years, and you can pay back 6 years, 7 years, and you are recovering here, so you will not consider the rest of the cash flows. Okay, not necessarily consistent with the maximizing shareholders wealth. It does not tell us that how much you are going to add in the shareholders wealth. So these are some of the disadvantages. Why do we use it? That is simple way, and we normally use it for the small investment decision, and normally helpful for the short-term projects. Now that the simple payback period does not consider the time value of money, now we can use discounted payback method. Instead of using simple one, we will discount them first and then find the payback method, right? For instance, we have these cash flows. First we need to discount it to year 0, 0, 0, and then we use them the payback method, right? So that is a simple thing. Simply you have the 100, so this is cumulative. 10 is the simple one, discounted for 1 year, so this is the discounted cash flow. This is the simple one, discounted is 49, this is 80, and this is discounted, right? So if you are using the discounted payback method, your payback time would be higher than the simple one, because discounted cash flows are lower than the simple cash flows. Okay, so that is just a simple case. And if you see in the project S, your payback is 1.87, while in the simple one it was 1.6. Okay, let's go to a different situation. As we know that NPV and IRR, they give different conflicting results when the projects have when the projects are mutually exclusive. And now when the projects are actually, when the projects have different lives, then what to do, right? So let's say there are two projects, project A and project B. Project A is for 3 years and project B is for 2 years, and this is the present value at 10%. So 12.49 is the present value of the project A, and project B has the present value of 10.47. so which one do you think is the expensive one? So if we take it from the perspective of cost, remember this is from a perspective of cost, not inflow, so we are taking this in terms of outflow. Okay, so if you see the cost, the project B seems less expensive than the project A, but project B has a life of 2 years while the project B has a life of 3 years. So it means which project should we go for? And by the way, how did we get 12.49? This is how did we do it, with 10% discount rate. Answer is 12.49. okay, so in that case, when you cannot tell that which project should we go for, then there is an option. Okay, what option is that? We use equivalent annual annuity method. Okay, so equal and annual annuity method actually tells you the cash flow or cash outflow for every period. Okay, so remember the formula that we use, PV is equal to C divided by R, 1 minus 1 over 1 plus R power n, right? So in this formula, if you remember, we have this PV, we have R, we have n, right? So for the projects we can use this information and can find C. So whichever C is lower would be the choice. Okay, let's get to the question first. You will understand easily. Okay, so once we have the timeline, so this is the timeline for the third year. So we are not using C1, C2, C3. We are considering that these are equal, C, C and C, right? So with the given NPV, NPV is given here. That was actually PV from the formula, because outflow was not given, inflow was not given, so that was actually NPV. Okay, so we are considering C, 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 they are equal. So when they are equal, remember the formula, when we have equal cash flow, then we use annuity formula, C divided by R, 1 minus 1 over 1 plus R power n. So we need to find C, so we need to adjust. Okay, let me write the formula, power n. Okay, so this is given 12.49. C is we need to calculate how much is the C. C is 5.02, and for the project B, same thing, we use 2 here, we use 3 years here, and then what is the answer here? Negative 6.03. Now can you tell me which one seems more expensive? Project B actually seems more expensive than project A. So every period, for every period, the cost in the project A is 5,020, while in project B it is 6,030, right? So that's why project A appears to be more economical. Okay, so if we have unequal lives in the project, what do? We use the present value of annuity formula and then calculate C. Whichever C is lower in this case, because this is outflow, we prefer that one. But if it is inflow, if it is not outflow like here, if it is an inflow, then we will select the one with the higher one if it is positive, right? So you need to make a difference for positive and negative one. Now we have another situation. The third method is profitability index. Okay, the profitability index helps you, profitability index, this topic. Okay, so profitability index, sorry, I'm not sure why is this ink creating problem, so please bear with me. Okay, profitability index talks about present value of cash inflows divided by present value of cash outflow, right? Outflow. So it talks about PI. Okay, profitability index means your return for $1 invested. So $1 invested earns how much? For instance, it is 1.5, so it means you are earning 50% more, right? So profitability index is equal to 1 means it is break even, mean cash inflow is equal to cash outflow. If it is higher than 1, it means we are making some profit. Okay, so profitability index is also another way of evaluating your what do we call investment. Okay, so if also profitability index is very helpful when we have limited resources. Okay, if there is a fixed supply of resources, then profitability index is very helpful in choosing the project. For instance, if we have different list of the projects and we are not sure which product to choose based on NPV, IRR, then best method is to use profitability index. Okay, so what is the formula here? That profitability index is equal to value created mean cash inflows, or what are the benefits, divided by resources consumed mean your outflow, okay, or your cost. So in other words, value created is NPV, or we can also use that PV, present value of cash inflow divided by resource consumed divided is equal to this one is equal to present value of cash outflow inflow divided by outflow gives you PI. So PI is equal to present value of outflow divided by inflow divided by present value of outflow. Okay, now we solve a question. After that this slide would be very easy to understand, okay, because with the statements sometimes we don't understand. Okay, let's see that your division at net a large networking company has put all together a project proposal to develop a new home networking router. The expected net NPV of the project is 17.7 million and the project will require 50 software engineers. So this company has actually set up a network router. It has an NPV of this one and it requires 50 engineers. Okay, net has a total of 190 engineers available. So for this one they have 50 engineers and they have created a net worth of 17.7. The total number of engineers of the company has 190, right, or 190. So and if we have a limited supply of 190, so it means how can we use these software engineers to create the projects with different NPVs. Okay, so for instance this router requires 50 head engineers and it will create an NPV of 17.7. project A will get you NPV of 22.7 but it will require 47 engineers. Okay, once we have this it means then which project should we choose, right, because there are many projects that we can see. So can we choose based on NPV? If we choose based on NPV, we will choose this one 47, then this one, right, then this one, then this one, then maybe we will not cover 190 engineers. But profitability index helps you to best utilize these 190 engineers, giving us the best maximum or the maximum NPV, right? So it means it will help us to choose the projects which will totally give us a higher NPV. Okay, so let's see the example. It would be easy. Once we have the NPV, then we have the head count. Next step is to calculate the profitability index. Okay, so this is the NPV and this is the head count. So consider this as the inflow and this is your head count. So what is the profitability index? It means it is 0.483. So every individual is contributing 0.483 of the net income, right? Here every individual is contributing 0.403 of the net income. So what do? We are actually dividing NPV divided by head count. We can get this answer. Okay, so we will calculate all that and we will sort it down. Okay, so initially we have 0.483 is the highest PI for project A. Project B, F has a second highest and then project E has a third highest. So we will sort the profitability index here. Okay, after calculating the PI we will sort it out. Now we can choose. So it means first of all we should choose project A, right? In our portfolio we should choose project A. It will require how many? 47. Plus we can choose project F. It will require how many head counts? 32. Plus project E, it will require how much? It will require how many head counts? 58. So we will keep on adding the projects until our head counts are how many? 190. Okay, so let's see. So first project is project A. So how many head counts? Required 47 and NPV is 22.7, right? And the second is F. Total would be 47. Then we will choose project E. Total would be 137 and project router it is 187. So how many employees we have? 190, right? But we cannot go for this project, of course it requires 40, but we have 3 only that are actually spared now, so it means we can choose these projects. Okay, so what is the portfolio of the projects? A, F, E and router. Okay, so if you combine their NPVs, would be the highest compared to any other combination. Okay, so NPV of this combination would be highest because this combination is based on profitability index. Okay, if you make another what do we say, combination, there that NPV would not be highest one, but the project selected based on PI would have the highest NPV. Okay, there is another example from another textbook. It would also help you to understand this PI. Okay, the situation is we have how many projects? A, B, C, D, E, F, G, H. These are the list of the projects, and these are the independent projects. So independent projects mean we are not actually rejecting them based on if we are selecting A then we reject B, but there are some other limitations. Okay, remember we can use the profitability index when we have limited resources. Okay, so for instance we have a limited resource of how much? 65,000. Okay, so this is the maximum budget that you can allocate for the project, right? Maximum that you can allocate, and within this budget which projects would you choose, right? If you choose project A, it will straight away cost you 50,000 and it will have NPV of this one, profitability index is this one, and IRR is this one. So these three different criteria are given, 1, 2, 3. Okay, so if you choose the project based on NPV, what will happen, right? If you choose the project based on IRR, what will happen? And if you choose the project based on PI, then what will happen? We need to see. Okay, so the purpose is, if we choose the project based on the highest IRR, the purpose is to increase total NPV of the portfolio, right? So let's see. Okay, remember our budget is how much? 65,000. so let's say we are selecting the project based on IRR here, then we are selecting the project based on NPV, and here we are selecting the project based on profitability index. Okay, so first project based on highest IRR is 37%. If you see, 37% is this project. Okay, so we are going to select project F. It has the highest IRR, 37%, but its cost is 10,000 and its NPV is 11,000. Okay, so if you see project F, it will cause and it will create an IRR of 37%. Initial cost is 10,000 and it will generate an NPV of 11,000. Okay, next, second highest is 28%. You see this one, its cost is 30,000 and its NPV is 42,000. Okay, so same, 28%, 42,000 and then 30,000, and lastly is 26%, and its NPV is 1,000 and its cost is 25,000. So 65,000 is the budget. You cannot exceed 65,000. So total NPV of the portfolio mean all these projects, is 54,000 with this combination. Okay, so this combination is based on IRR. Next combination, we are going to select the project with the highest NPV. Okay, so highest NPV is how much? Where is the highest NPV? This is the one. Okay, 42,000 is the highest NPV. Then after 42,000 we have 15,000, then 12,000. Okay, so let's see, if you select this 42,000, what is the cost? That is 30,000. Okay, so NPV 42,000, project name is C and its initial cost is 30,000. After that you can select project B. It has an NPV of 15,000 and its cost is 35,000. so the total would be 35. So based on NPV you can select only these two projects. Okay, and if you see the NPV combination based on NPV, it has the NPV of 57,000, while based on IRR its NPV is 54,000. Okay, so for now and criteria based on NPV is exceeding. But let's see where we go for the PI. Okay, so so which one has the highest PI? PI is this one, 2.4, project C, number 1. Then we have number 2, number 3, right? 1, 2, 3. So it means C, G and F. C, G, F. So based on profitability index. And then we what is the initial cash outflow for the C? It is 30,000, 10,000, 10,000, how many? 50,000, right? So it means we have already selected 3 projects, and the fourth one is 1.43, no, 1.67. its cost is how much? 15,000. okay, and its NPV is 10,000. So if we select the fourth 1.67, so the total, this is our budget, and this is the NPV. So combination 3 based on profitability index has the highest NPV, right? So if we choose the project based on independent project based on PI, they will give us the highest return possible. Okay, they will help us in selecting the projects with the best NPV. Okay, so what is the story for this IRR? IRR basically helps you when you have limited resources or when there is capital rationing. Then IRR is the best way to select the best possible options. Okay, now last slide is popularity and usage of investment decision method. In terms of consistency with owner's wealth maximization, normally we go for NPV and IRR. Basically these are the most widely used method. Okay, so NPV is estimated added value from investing in a project, therefore this added value should be reflected in company stock. Okay, because NPV is considered as the shareholders wealth maximization, whatever is added, it's actually reflected in the company's profit. When company's profit mean the shareholders price. Okay, so it means when company makes some NPV, makes some profit, it is automatically reflected in the share price, while IRR is not reflected in any of the shareholders wealth, because IRR is just a way to evaluate a technique, but NPV is the actual thing that actually adds and gets added into the shareholders wealth or stock price. So it actually translates into that wealth of the shareholder. Okay, after covering the topics in detail, now let's finally discuss the mind mapping. Okay, so this is the mind mapping for overall chapter, so it would be easy for you to keep it in mind. As we know that we discussed in the start that this investment is from the investor corporate perspective. So this is a corporation. So corporations actually issue or sell financial assets, so in the form of bonds as well as shares, and we call it as financing decision. So through financing decision, companies, they get funds. Okay, so this is selling the financial assets, and these financial assets will be evaluated by these investors. Okay, so once the company gets these funds are then used to buy real assets such as machinery or plant, and this is called investment decision or corporate investment decision. Okay, and now next step is, once we have decided that we are going to buy any machinery or plant, next step is to evaluate them, right? Evaluate them mean we have to see if the benefits are greater than the cost or they are less than or equal. So we need to actually do some evaluation. Okay, and for the purpose evaluation, we have two methods. Number one is non-discounting method and other is discounted method. Non-discounted method does not consider time value of money, while this one considers time value of money. Okay, so in non-discounted method we have accounting rate of return and simple payback. So this is not covered here. So we have our more focus is on discounting methods,
And in discounting method we have discounted payback, because this method talks about the time it takes to cover your initial investment. And then profitability index. Profitability index talks about your return per dollar. Okay, if you invest $1, so how much are you gonna get on this $1? Profitability index actually helps you to answer this question. Okay, and then we have internal rate of return. So this is a theoretical rate that talks about in percentage, and this is also called a break-even point, and this is a theoretical rate. Okay, so it talks about in percentage, per dollar, and time. And lastly is NPV. NPV is also called shareholder maximization approach, right, or wealth approach. So it talks about total uh, profit or total wealth do you get here in percentage, in dollars, in time. This one is in total amount. Okay, as we know that between NPV and WACC there is an inverse relationship, and this inverse relationship is called NPV profile. Okay, so these are the topics we discussed. So after that we have two techniques, NPV and IRR. There are some issues in IRR. We have to choose between IRR and NPV, and to choose between IRR and NPV we have to have some understanding of conventional cash flows and non-conventional cash flows. In conventional cash flows, if NPV says that we have to accept, this green mean accept, IRR also says you should accept. Or in other words, if NPV says do not accept and IRR also says do not accept, also both NPV and IRRs, they both say that do not accept. So there is no conflict if the cash flows are conventional. So please remember that when the cash flows are conventional, there is no conflict between NPV and IRR. So if you have calculated NPV, so you can say that okay, IRR also would say to accept this project. But for the non-conventional cash flows, NPV, if NPV says accept the project but IRR would say do not accept, or in other words, if NPV says do not accept the project but IRR would say accept the project, so there is a conflict. Okay, so what is the solution for that? Solution for that is and in that case we have multiple IRR, so that's why we have a solution called MIRR. So when we will calculate the MIRR, because you know that the conflict was between NPV and IRR, so after we calculate MIRR, so there would be no conflict between NPV and MIRR, not IRR. Okay, please remember that it would be MIRR. So if NPV says accept, MIRR would also say accept. If it says reject, if it will also say reject the project. Okay, so there will be no conflict between non-conventional cash flow if instead of IRR we calculate MIRR. So this is the mind mapping for this topic, and it is also provided at the end of your slides. Okay, thank you so much.